Hello and welcome to a new episode of Beyond Core, the podcast for business leaders who dare to think beyond today's success and build the future. In every episode, we explore entrepreneurial strategies for unlocking new growth beyond your core business, from platforms, digital ecosystems, AI-driven ventures, and circular business models. We dive deep with industry pioneers who are shaping what's next. If you are looking to scale innovation, create new markets, and future-proof your company, you're in the right place. And today, we will explore the topic of corporate venture building. As you know, companies have multiple options to innovate. They can buy companies, they can partner with other peers in the ecosystem, or they can build their own new businesses. And corporate venture building is exactly about this, building your own new S-curve of growth. So we will today explore this topic in detail, and I'm doing it not alone. I have also my favorite co-host with me. Hello, Natalie.
Hi, Matthias. Great to be here again.
Yes, as always. And we as a duo, we have also a special guest today. We have Martin Sondenheimer. He is the former global head of corporate venture building at Munich Re, an insurance company, and he is also expert in corporate venturing and innovation. Hello, Martin.
Hi, Matthias. Hi, Natalie. Nice to meet you, and thanks for having me in your podcast. Great pleasure.
Great to have you, Martin.
Thank you.
Perfect. So let's go straight into the topic. So, Martin, maybe you can tell a bit more to our audience who you are, about your journey and your experience in building corporate ventures.
Yeah, happy to, Matthias. I have always been fascinated by how new technologies, emerging technologies, change and can transform industries and businesses. That's why I spent my about last 20 years in building, investing in and transforming businesses. First as a management consultant for many years, then as a corporate venture investor, and in recent years as a venture builder. You mentioned in my last role as global head of corporate venture building and managing director of 1880 Forward, which is Munich Re's digital ventures holding company. I had the great opportunity to build, first of all, a corporate venture building unit from scratch. And then together with the teams in the US and Germany that I had built up, we have been creating and launching more than 12 tech businesses in the fields of insurtech, fintech, climate tech, agtech, cyber, and IoT. Most of them we have founded as 100% subsidiaries, as well as some, as I would call them, real founder-owned or real startups, where 1880 Forward holds a minority share. After we incorporate those startups, we then guide those companies through classical board seats, approaches, and governance setups that we have also created for our ventures there. And happy to dive a little bit more in detail onto this topic later as we go. Maybe what's interesting to mention in addition is in my first years in this role, I probably spent, I would always say, half of my time, and I underestimated that amount, I have to admit, building this corporate venture building framework and system. Meaning first of all, the definition of the corporate innovation and corporate venture building strategy, hiring the team, establishing the right processes and approaches from ideation to incorporation, and then especially building up this independent operating venture studio, including capabilities such as HR, incorporation, go-to-market, product, finance, etc. And about the other half, I spent on actually building this. Going forward, I will advise and support corporates as well as their startups along the entire life cycle of corporate innovation and corporate venturing, from innovation strategy to the development and setup of innovation vehicles, as well as supporting companies in their execution of their innovation endeavors, to also supporting companies in the exit of venturing activities, which happen to be quite a relevant topic in recently. I live in Munich and I enjoy living here with my 3 kids who keep me also very busy day in and day out, as you can imagine. Again, thanks for being here.
Yeah, so kids are always like ventures, right? So you need to grow them up and scale them and help them to grow in life. So you have a fantastic business vita, but also a very good experience with your kids. So let's go straight into the corporate venture building topic itself, as it seems like you are very knowledgeable about it, but also you experienced a lot. And corporate venture building is not a new topic. It's been out there for a while, so 10 years, 15 years or so, where corporates follow this path. So what do you think is the current status quo of corporate venture building? So what happened in the last 10 years and where are we right now with this topic?
Yeah. Well, let me first, if you allow, quickly sort out a little bit the instrument of corporate venture building compared to the other instruments, because I think they're always a bit mistaken sometimes. So let's take corporate venture capital, so investing in startups, and venture clienting as one group of instruments, for example. For me, this instrument has the aim to get access to new technologies, to learn from these new technologies, and then to ultimately use these technologies within the company, the mothership. It can also be a step into or a foot in the door for M&A, of course. Venture building, on the other hand, I see as an instrument to build new businesses that will become relevant, hopefully, for the company in the future, either with the purpose of generating revenue or with the aim to increase or to create company values, enterprise value. If you look at the different phases, and you said it's around for quite a while. Recently in a group, we discussed, okay, what are the different development stages we have seen so far in corporate venture building and where is it heading next? So let's start a little bit with a view back. So I would distinguish between roughly 3 phases. The first phase we can call the experimentation phase. So in this phase, corporates experimented with the instruments of venture building. Typically, they didn't have a big strategy behind, nor did they have own teams, and mostly fully outsourced the building of a single venture, which was typically the start to venture building consultancies. In a second phase, then, companies have set up own teams, have established lean startup thinking, have established a customer-centric perspective when building new businesses. But there was one challenge with it. Ventures were typically not thought from the end, meaning from the investor perspective. So when it started, it was yet unclear for most ventures if they will become, a full subsidiary of the corporate or should enter in the VC world. Now, in the third phase, we've seen units mastering this challenge. So the units became highly professionalized. They set up, own companies, independent companies, with a well-oiled incorporation machine, and took this, as I mentioned before, this investor-centric approach, where they thought about, okay, cap tables, etc., and how a venture needs to be investable for professional investors. But that created one other challenge, because with units becoming more and more investor-centric, my observation is they not only operationally moved away from the mothership, but also strategically moved away from the mothership, which created new challenges. I think despite this different or this already time around in these different evolution stages, for me, corporate venture building is still a young function in the corporate world and probably in its kindershoes. And I'm sure we'll see more stages and waves coming, and we'll see a further maturing of this instrument going forward.
Actually, I totally agree with you. I think even though we've been hearing about venture building for a long time, there's, like you said, there's some stages of evolution, a bit like digital transformation, which we heard about how many years ago? I don't want to sound too old, but and that we are still in some phases of this, especially with artificial intelligence and everything. Um, So it's kind of in its infancy, yet there's been some maturity stages. And I think actually um, you've been, I mean, there are not that many corporates that have been through those phases yet, still, despite the fact that the model has been existing. So you've been a pioneer. Um, with the state of flux we are in, all the economy at the moment, we see some hesitations from corporates. Should we go beyond core and maybe via corporate venture building? Should we refocus on the core? What do you think what's your opinion, and what do you see happening in corporates?
Yeah. Well, there's different signals in the market I'm seeing, and they're somewhat contradicting. On the one side, there are voices and studies saying new business building will become the top priority of CEOs this year, which is great news, I think, given all the turmoil and Europe needing to invest into its own future even more. On the other hand side, we have seen a lot of companies discontinuing their corporate venturing activities. I think not only in Europe but also in the US. But there's a growing cemetery of units of corporate venturing units. If you would ask me for the reasons why they discontinue or close, I think there are different reasons. We have seen, you mentioned one, refocusing solely on the core business is definitely one topic we see a lot. Distressed situation of the mothership is another one. And then probably also to some degree disappointment about the strategic and or financial value that was created from those units. And this, for me, this applies, and what I've seen applies similarly to venture building units as well as for corporate venture capital units within the corporates. My personal belief is, and my conviction is that companies will need to reinvest in growth and innovation, and in order to remain relevant in the future and to become or remain future-proof, given all the developments we see at the moment. And I'm personally very much convinced that new business building, by using techniques like venture building, will continue to be a very relevant instrument of innovation going forward for companies, especially for those companies that have a long-term perspective, have access to the necessary capital, and have interesting corporate assets, which is important in venture building, to leverage them as an unfair advantage to build new businesses. Maybe also a bit closer to the core than we have seen building businesses so far in the last couple of years.
And how do you see the latest trend of AI maybe fueling corporate venture building? Because, as you said in your last sentence, it's very important that corporates leverage their assets. And one major asset is the data corporates have. They collected massive data in the last years of 10, 20, 30 years, whatever. They also, with the digital transformation, digitalized a lot of those data points. And now they can leverage the data to fuel their own AI models or whatever, and bring up new products, services based on AI. So could this AI be also a kind of a spark for corporate venture building?
I would say yes and no, and probably a little bit too early to tell. But let me say a few words on my perspective on this. First of all, at the moment, I'm seeing companies leveraging generative AI, large language models, mostly for the purpose of automation, process improvements, productivity. So it's more an instrument to affect the bottom line, if you will, than an instrument to build new businesses. That's probably, I would say, the next wave we'll see after companies have become a bit more experienced in using AI as a technology. I come from an industry where data always played a big role. And I think if we look a little bit beyond the hype, first of all, we see that having your data properly in place is still a big topic and a prerequisite for all kinds of AI activities. So this remains, I think, an ongoing challenge. But let's not go down this road too much. Now, if you think about the combination of AI and new business building and venture building as a technique, I can very much imagine that the way you work, the way you build new businesses through using these venture building techniques will also be interesting for building new products, new use cases that are infused by AI. So we already see some venture building units, I would say, becoming also a somewhat AI product studio. So we see this is definitely one outlook I have for venture building units, that they become kind of this AI product studio going forward, which is a good thing probably, because we can leverage methods and processes, again, like Lean Startup that I mentioned earlier, and a lot of learnings from how to build new businesses. You can leverage this in AI and build use cases, products, maybe even businesses a bit more close to the core by using AI. So that would be my 2 cents on this.
And also maybe enrich a product or technology focus with a business focus. So often, we think of AI as an end goal. We need to do AI, right? What do we do with AI? But what's important is not so much the technology, which will happen somehow. It's what business model do you put above that? What use case do you use it for, etc.
Mm-hmm.
I have a question on what you said earlier. You said maybe some corporates are somehow disappointed with the outcomes of corporate venture building, of corporate VC, and I would say a bit more broadly also with entrepreneurship and open innovation. What it made me think of, and I'd like your view on it, is that I think all corporates have to innovate. It's a question of surviving, I think. But because a lot of people are becoming or are professional in innovation, we tend to forget that innovation is taking a risk. And so we are disappointed because there are some failures. But at the end of the day, when you innovate, you are taking a risk, and you need to accept some failure, even if no one of us want failure. By professionalizing through the venture building process, for example, then you reduce the risk, but you never delete the risk. What's your take on maybe the appetite of companies to take that risk? Or
well, I think, first of all, the reasons are manifold why things don't work, right? And I always say that as a corporate innovator, you have another front where you need to fight, right? You don't fight in the market with your competitors for clients, but also you have your kind of internal fights that you need to fight with your HR, communications, finance, and departments, right? So there's another front which makes life as a corporate innovator and corporate venture builder and investor maybe even a bit more complicated than just being completely greenfield. So one thing for me is you need to find a balance between avoiding, how I always say, the corporate disadvantage, right, of having this other front, and on the other hand side, leveraging the corporate advantage, so leveraging interesting assets the company has. We mentioned about data, but also customer access, brand, etc. So there's things you can leverage as an innovator that the company has, which can be an unfair advantage if you balance the corporate, let's say, a disadvantage and an advantage, right? So that's one. Another one is maybe let's call it patience or long-term perspective. I mean, we know that. Let's take the example of venture capital funds, right? They typically last 10 years. And after 10 years, you look, have you, developed and invested into a successful portfolio of corporate startups, of startups. As a corporate, I have often seen that your duration of patience is the board tenure, right? And if you have a board change within this tenure, you may not have the right amount of time to be able to really demonstrate success. So that's definitely one thing, patience, right, within corporates to go the whole journey of corporate innovation, corporate venturing. And then maybe another aspect which is a bit detailed but interesting. If you build, and we're talking about corporate venture building, so if you build new businesses as a corporate, you can either build minority ventures where you hold a minority share and you can build an interesting portfolio maybe. If you build, majority companies where you control most of it, you can hardly build a portfolio of 30 companies, right, as the VC does, to have this portfolio risk effect, right? So there is by design a higher risk, I would say, in this sense, because typically you don't have these big portfolio sizes as the big venture capital investors can afford, because they only invest a little bit in a lot of companies and not a lot in a few companies. So that might be a systematic higher risk aspects within corporates, if you will.
Yeah, I think this is also introducing the next question a bit. So, as you said, they can maybe build ventures they fully control, or where they have the 100% shares on this venture, or they can have minority shares. Maybe you can also give a bit more an intro to this topic. So, what are the pros and cons of each of those ways?
Yeah. For me, I see three fundamental different types of models of corporate ventures. And that's a result of a learning journey within myself, within the company. And I really don't see a lot of other models than these three. And I make it a bit black and white on purpose. The first model for me is, I would call the majority-owned venture. So this is a setup where the corporate parent controls the majority of a corporate startups and typically holds 100% of these shares. Then the second model is the other extreme, where the corporate only holds a minority share, typically between 15 to maximum 20%, to keep it VC ready and investable for VCs, and where the founders hold the majority of the share. You can now say, okay, how is this different to venture capital investment from the cap table? It's not. But the difference is that you, in this case, you as a corporate initiate this startup, but then typically give it to a founding team rather quickly. So that's the other extreme, where the corporate only holds a minority share. And then the third model for me is exactly in between, you can say, is joint venture type models, where two or more corporate or strategic investors share equal rights of the startup. So that's the third model. I've often seen a misunderstanding in corporate ventures where the board then says, well, we have 80% of the company, or no, we want to have 80% of the company, and let's find an investor that takes 20%. Right. And I think many realize that this is not working because financial investors don't want a corporate to control the majority of company and then become an investor because they want, proper cap table set up. So this is, I think, one of the myths that many venture builders have seen at the beginning, that these approaches don't work. So you either go in full as a corporate, then you need to fund full and to the end, or you make it VC ready, but then you can also only have a share of maximum up to 20%. I think the two models are also very different. And just to mention a few examples. So first of all, I think the strategic intention behind building majority ventures versus minority ventures is very different. If you build majority controlled businesses, you typically do this in areas where you want to complement the core and eventually spin them back in after a while. While if you're building minority ventures, the intention is really to leverage these unfair advantages in a new business model that you then exit at some point in the future. So you basically want to monetize existing assets in new fashions, while in the majority controlled ventures, you want to build new businesses that you eventually spin back in. Also, and we touched on this a little bit already, also the building of majority or minority ventures is very different. So it typically you initiate both within the corporate venture studio. But for the minority ventures, you are quickly hands off. You're quickly either starting this already with the founding team or hiring a founding team, and you're quickly incorporating this let's say founder-owned startup. While if you're building corporate controlled ventures, they typically you found them much later. You're more hands-on as a corporate, and you're more operationally involved. But again, the key difference is, as I mentioned before, the portfolio size. So if you need to fund 100% of a venture versus 15 to 20%, there's obviously much less ventures you can build and fund. So we see the portfolio sizes of venture studios that build minority ventures are typically much bigger than those building majority ventures.
I think the portfolio element, you mentioned it a few times already, it's key. And it goes back to what I was saying about risk also. The bigger your portfolio, the more you're kind of leveling the risk. So based on what you just said, any idea which model is more relevant or works better for companies? Fully owned, partially owned, or mixed with other companies?
Yeah, that's a tricky question, of course.
Yes.
I think there's a justification for either model. It really is a different intention, first of all. When I look into the market, I think we have seen the venture studios that build, again, how I call them minority-owned ventures. I think they have shown that this model is working. So they have built well-oiled machines where they shoot out ventures very quickly that are VC ready and investable by VCs. So I think we've seen this model is proven in the market, I would say. There's one challenge I personally see with that. It may have become less strategically relevant for the mothership. So while taking a very, as I mentioned earlier, a very investor-centric perspective, how to build companies, which was needed to attract financial investors, the corporate mothership has been forgotten a little bit, and thereby the strategic relevance of what these venture studios build. So you can say it works operationally, strategically relevant, question mark. If you look to the other model, on the other hand side, it's more complicated to build a well-oiled machine if you're building majority-controlled startups, because there's just more things you need, more complications, right? And I don't want to go into the details of consolidation of these companies into the mothership, the balance sheet of the mothership, and other things, or attracting talent. But this is much more complicated if you build majority-controlled ventures. On the other hand side, you have the chance to, to build stuff that is more relevant for the mothership than, let's say, if you're just building minority ventures.
It seems that, sorry, Matthias.
Yeah, go ahead.
It seems that it's a choice. It's really a strategic choice, and the intention you put into building ventures. Do you want to build your next S curve and like maybe it becomes your next core business, or it does complement your core business and accelerates it? Or do you want to build financial assets that you then monetize to maybe feed your core business? So it's really that's my understanding anyway. I don't know if I got right what you said, but that's kind of what intention do you set at the beginning from a company perspective?
I would say so, yes.
Yeah, it also went into the same direction. I wanted to ask, is there a correlation between the shares you own versus the proximity to the core business? So if I build something new very close to my core business, then maybe the shares I own are much higher, 100% or whatever. But is it more like the next S curve for ahead 10 years ago into the future or whatever? Then maybe the shares are only 20% or whatever, because I need more innovative people from outside thinking beyond my core. Do you see also this correlation, or is it?
Yeah, I mean, it's obviously not that simple and not completely black and white, but still, I would see there is a tendency towards this. Yes, the more strategically relevant the business is for the mothership, there is a tendency to want to control it. While if it's not as relevant, there might be a tendency to have it a little bit further away from yourself. But it depends often also on the very specific situation. So from my own experience, I can say we had one initiative, for example, where we have there's a strong connection to the IP of the mothership, and that's something no one wanted to be floating to the outside world, where we're not fully in control. So that was one aspect, and then another aspect where we said the topic is interesting in the long run for us, but maybe not so much in the short run. And there's also little we can do to make the venture better in the short run. So let it be rather independent. Let's watch the market, how the market evolves. Let's see how the venture evolves, and eventually, we'll learn with that. And there's always a chance to invest more in the future. But it's more a learning case then, which can be strategically relevant in the future, but not in the short run. So there's also a time dimension probably to it, I would say.
Or maybe also an HR perspective. You briefly touched it with talent acquisition or talent attraction. So if it's more closer to the core, then maybe you can bring in the people from inside of the core, from inside of your mothership, because you have also talents there, and who wants to become the next entrepreneur and residence for this venture. But if it's more far away from the core, then maybe you need to attract different types of talents you don't have as a mothership. So, and they also demand more control of and more incentivations. So how do you see this with the talent attraction and incentivations?
Yeah, that's obviously one of the most challenging topics as a corporate venture builder. So for the minority ventures or founder-owned ventures, it's simple, right? If you have set up the venture right, if you have set up the cap table right, and if it's generally VC investable, I think it's for a corporate venture, it's as easy or as simple to get great founders as for any other startup, right? And the incentivization mechanisms are the same. So it's like a real startup, if you will, with the only exception that it's initiated by a corporate, and the corporate holds a first, let's say, seed investor or pre-seed investor share, either real shares or convertible loan, of, let's say, up to 15 to 20%. So there it's like in any other startup, right? And I think there's good ways to get good founders for these things, because they will look at the cap table first of all, and the top and the product, of course. Now, for majority or corporate controlled ventures, it's a completely different game, right? And I've experienced it in many cases. I have built in the past. Getting a real founder type talent to majority controlled corporate venture is very unlikely. But it's okay. I would say you can attract other great talent. And talented CXO to the companies. It's just a very different, let's say, profile and setup. So typically, I would call them not founders, but employed managing directors you hire at these majority-owned corporate startups. They can partially come from the mothership. In my experience, we've mostly hired them from the outside world, because you need this ability to build a new business from scratch, like a startup. So there's different, let's say, talent requirements that you need to have that you typically don't have, let's say, in your line job within the corporate. So if I look back to the ventures I have built that were majority owned, probably still 90% of the talent were hired from the outside world. So little come from the mothership. Some come, and and those who came and those that we have are critically needed because they're very often subject matter experts in the specific field. For example, cyber risk expert, right? So there's great subject matter expertise in the mothership typically, but maybe not always great, let's say, entrepreneurship people, let's say. But it's also a different, let's say, culture to some degree. So if you are 100% subsidiary of a corporate mothership, typically the corporate is a bit more hands-on and operationally involved than in a startup that you invest in. So as CXOs of a majority corporate startup, you are less in control of your full destiny. And you need to be able to manage also a complex stakeholder landscape at the corporate level, which is a different requirement than, managing your investors. VC investors can also be challenging, of course, but it's just a different type of, let's say, stakeholder landscape, and thereby it requires a little bit of a different capability set. Now, we can also talk a little bit, if you want, about incentivation, because that's naturally the next topic after attracting talent. How do you incentivize talent in corporate ventures? Again, for minority-owned ventures, it's easy. It's like in every startup, the founders hold the shares, so that's simple. In majority-owned ventures, it's again also more complicated. I have seen models where the founders, or let's step one step back. What's the complication? So the complication can be if you give an employed managing director shares, there's typically not a liquid market for these shares, right? So who do you sell these shares to? No financial investor will buy 5% from a founder who wants to monetize their shares if they get 5%. So there's the problem of liquidity of this, of if you give a founding or a managing director, let's say 5% of the company. So there's two approaches, I think, that became popular. Both have advantages and disadvantages. One would be you give an employed managing director real shares, typically with a put option to be sold back to the corporate if certain milestones are met after a few years. This is a possibility. There might be a tax challenge when granting real shares, but there's also ways to avoid this. And then the second instruments that I have also been using a lot in the past was you grant not real shares, but some kind of long-term incentive bonus that mimics virtual stock options. So it's something that where you don't have real shares, but you benefit from an exit event, right, by participating in the value that you've created. It's a simple instrument, but it also can come with some challenges. One is it must be taxed as income when being paid out, so that's a challenge for the managing directors. And the second one is and that's now going completely into the complicating details, but and this applies for both, is as a corporate startup, you need to also demonstrate those, let's say, share programs in the balance sheet of the mothership, which can be painful if you need to do this, because that's something typically the mothership doesn't really like to do.
Yeah, so it is the talent acquisition is also hard for, let's say, having those talents coming from the mothership itself. I also see that finding them and seeing them, hey, you have entrepreneurial talent is good, but they also want to understand, hey, what is in for me? I'm now leaving the mothership, and now with a low risk job, I climbed up the career ladder. I have now a high paid job. I have a fantastic outlook. Maybe in the next years, I can further climb up the career ladder and maybe become a director or maybe becoming part of the board or whatever. And now you ask me to take over a high risk startup. I don't know it will exist in the next 3-4 years. I should build it. Of course, it sounds interesting and challenging. It's fantastic, but hey, I'm now leaving this secure space. So I definitely want to have shares. I definitely want to have more reward than I would maybe see in the old area. So it's not just like giving them maybe virtual shares or whatever, but it's also hard to attract them. So I think right now, what I see is also attracting the talents from outside. So for your corporate startups, it's sometimes easier because all the internal talents, they are talents, but you cannot really convince them with the right model. Or do you see this challenge as well?
Yes, of course, it is a challenge and a dilemma for the individual. But you need if you have a 3 people managing director team of a corporate startup, right? And let's say 2 come from the outside world and 1 come from the inside world. This needs to be somewhat balanced as well, right? You can't have completely different, let's say, logics of incentivation and also of compensation. This will create tension at some point. So you need to balance both worlds a little bit. So what I've seen is I would say for 90% of internal talent, this is not the right move, right? Because as you said, if someone is looking, okay, how can I avoid further risk to move to the next career stage, this might not be the right approach to do that, because this is high risk, because it can fail on day 2 if you jump on it day 1, right? So it can fail every day. So you need to be really, first of all, passionate about the topic and about the product. You need to be willing to learn through and have hard learnings. And I think it depends probably also a bit on the culture of the mothership. So if these things will be rewarded failure as a learning journey for the individual, I think then this can work. But if it's seen as, okay, he didn't, he failed in venture 1, then he failed in venture 2, there's nothing we can do with this person anymore, then you will never see someone moving over there whatsoever. I've seen corporates trying to build a bridge between the two worlds, and I still have mixed feelings about this bridge. So what do I mean with that is, there's 2 ways you can say. You can say, if you, as a corporate employee, if you want to go to this corporate venture, you need to leave your corporate job, and there's no way back, right? If you're in, you're in, and if it fails, you're out, right? So that's the more radical way, which mimics also, let's say, market mechanism in its best way. However, if corporates who do that realize there's a single corporate person doing this, right? Typically 0. So that's why some have built a bridge. So they mimic, real startup scenarios with new employment contracts, new bonus systems. But for a while, there is a bridge back to the mothership. So, for example, if you say, if within the first 2 years, the startup still exists, and the talent from the corporate still wants to remain there to get the bonus in year 5, then there's a bridge back in the first years to go to the mothership in this sense. So there's ways that you can smoothen things for corporate talent, but it remains a complication. I think that's reality. Yeah.
Maybe now looking out, you mentioned earlier 3 stages already that corporate venture building has been through, or the maturity stages. What do you see as the next phase? How can corporate venture building remain relevant or become even more relevant? What's your take on this?
Yes. So I'm a believer. It will remain relevant in the future, first of all. But I think we are at an inflection point where we see maybe even a 4th evolution stage happening at the moment. And I mentioned earlier, in stage 3, we have seen this very investor-centric perspective, and venture studios having created well-oiled machines that are with market-ready VC investable startups coming out of them. But maybe by sacrificing strategic relevance of those startups. So looking ahead, I think my outlook would be that corporate venture studios that create highly strategic relevant businesses for the mothership will become more relevant. And also those that have cracked the dilemma of being operationally independent from complications of the mothership while being strategically highly integrated. I think those who master this, let's say, contradiction will be successful in my perspective. And then a second scenario I see is that you also indicated, Matthias, earlier, is that we see some venture studios pivoting more to become AI product studios, because this seems to be, let's say, in the short run, even more relevant to build AI products and use cases by using these venturing techniques and sandbox environments than building new businesses. But again, with I think with Europe and companies in Europe, if they want to remain competitive and future-proof going forward, we all need to find back the path to growth and innovation. And I think with the two things I mentioned, more strategic businesses and ventures to be built, and using venture building techniques to build AI product studios. These are the two scenarios I think that corporates may have to go back on the growth path going forward.
I think this is a very good outlook. So it stays relevant, but it will also, of course, change. So I think you covered a lot of great elements of corporate venture building. So we learned a lot, how it has grown in the last years, but also what is right now the challenges of corporate venture building, and especially with incentivations and strategic direction and stuff like that. But also the outlook with AI coming in and how AI can shape, or is maybe in another battlefield for corporate venture buildings, and they can maybe a bit of spark also in this AI direction. So thank you for sharing your experience and your expertise on this whole topic. But before we close, maybe there's a last question we always ask our guests. It's about the recommendations for kind of books or podcasts or other sources you think maybe they helped you in the last years and they inspired you, and you would like to recommend to other leaders listening this podcast, and to follow or to listen to read or whatever you think, or to watch, and to take away maybe also some learnings like what you had done.
Yeah, well, there's many to mention, but what comes to my mind, maybe let's start with books. First of all, the last book I've read, called Moral Ambition from Rutger Bregman, I think it has been quite in the press in the last couple of months. It's not an entirely great book in itself, but what I really liked is about, the message behind. It's about, as a talent, how about using your skills right, in the sense that how do you use your skills to solve the big problems of humanity and life on Earth, rather than wasting your talent in jobs that are just filling the pockets of some privileged people. So I like the message, and it got me thinking of how to invest my own energy, to be honest. And the book I'm reading at the moment is a new one from Harari called Nexus. It's the fourth book I'm reading of him. I'm always fascinated by his books. So I'm just at the beginning of this, so I'm not sure I can fully say a lot about the last one. But all books I've read from him have given me completely new perspectives on things that I have never had before. So I can definitely recommend all his books. The last one, Next, is about the information age and how information has brought us where we are today, and the relationship of information and truth, which is a very relevant topic, giving things we see at the moment as well. When it comes to podcasts, I'm listening to many podcasts. So it's very difficult to pick out the best ones. But I would like to mention The Daily from the New York Times, which is more a political podcast. But every episode I listen to them, I'm always fascinated after I've listened to it. So it's typically one specific story where they go deep into the topic, understand the situation and the root causes of things. And it's always, I've always learned something by listening to these episodes of the podcast. So I can definitely recommend The Daily from the New York Times. And there's maybe one other thing is, which is a bit more relevant maybe to the topic we talked about, is the learnings. So as a corporate venture person, there's typically little people within the company that you find that you can talk to that know how to do things better. Maybe they know about subject matter, of course, right? So cyber, IoT, they're perfect experts there. But how to build your well-oiled machine is something you don't find within the company. So exchanging with your peers, talking to external experts, I found always very helpful, and there I have learned a lot, and that's why I, entertain these exchanges quite a lot with other companies, because there I learned a lot in my past.
Yeah, I think this is absolutely true. That's why we also invite experts like you on this topic to exchange, and also to not just that we are talking to each other via a video call, but also to record it, to make it available for the audience. So it's a win for us, but also a win for the audience listening to this conversation. Martin, thank you very much for joining this podcast, this recording. Very insightful information, and we will put your recommendation on the books and also the podcast into the show notes, and also a link to your LinkedIn profile. So if anybody wants to connect with you and maybe continue this conversation, then he can connect to you, I'm sure. And yeah, looking forward to the published version very soon. And thank you for joining.
Thanks for having me, Matthias and Nathalie.
Thank you, Martin, for this very interesting and thorough content that you gave us.
My pleasure. Thank you so much.
All right.